Chris Baggini, one stock you like over the Turner Titan Fund is Disney. It's down around 8% year to date. Most of it is because of concerns about its ESPN business. Why aren't you that concerned?
Well, if ESPN was our only business, I would have some concerns. But there's a concern that has been addressed, I think, over the last 9 to 10 months and has been reflected in Wall Street expectations. So the company is at its roots a consumer products company. They've got more products than just ESPN. Obviously, Star Wars was a big hit, much bigger hit than expected going into the holiday season. But there's more after Star Wars. There's more after Marvel. The theatrical releases that they have coming up over 2016 into 17 are terrific. The consumer products they sell after that are also exponential. What I would also add to that is they have theme parks. The Shanghai park is going to be opening up this year. It's not going to be wildly profitable as a park, but it's going to be also creating a halo effect. The company has pulled back. It was $120 a share last summer, and yet earnings revisions have moved up consistently, even with this ESPN overhang. And it is an overhang. There's a mismatch there between costs and revenues. The timing of the costs, what they pay for NFL rights, all the other rights for all their sporting news. However, I think that this is fully reflected. The stock is on sale now.
All right, well, Star Wars was also a hit last quarter for Electronic Arts. That stock is also down around 8% so far this year. But what really hit them was their guidance. So how can they get the stock moving higher going forward?
Yeah, so Electronic Arts has this tendency of beating and then maintaining or lowering the forward quarter. Last quarter was a very strong quarter, especially for Star Wars. They did 13 million units. The mix last quarter was more for actual discs than it was for downloads, which is totally different than what's happened over the last 2 years as EA has rallied significantly. But what we see going forward is a return back to more of a download mix versus digital. And what that means is higher gross margins. They have also a terrific slate of new products coming out this year as well. Their product set is also recession resistant. So if we have a slowdown in the overall marketplace, gaming sales have notoriously been anti-cyclical or non-cyclical. We see further expectations are too low for EA going out through the calendar year. They have a big analyst meeting coming up in May, and I suspect they're going to be talking about shareholder returns of on the order of about 10% of capital.
All right, now another stock you like is Alphabet or Google, whatever you want to call it. Everyone's going to be looking towards their Android business, their YouTube business, because they think the search business is solidified. So talk about those two businesses and what they can do for Google in 2016.
Sure. Those are two very hot areas, YouTube in particular. Downloads for YouTube accelerated. Just as we thought that was so big it couldn't possibly see greater downloads, we actually saw an acceleration in downloads in YouTube over each of the last 2 quarters. And let's not forget, search is really their core engine here. Search actually accelerated for the second consecutive quarter. All that meant was revenues actually accelerated for the firm. Now there's still a big mix here, a big change rather, in advertising budgets from non-digital to digital. That's everything from TV to print media to digital. And Google and Facebook are the 2 companies that are really dominating that area. Search in particular, both clicks, which is a number of clicks that go through, as well as pricing continues to be terrific for them, beating expectations. But really, as you mentioned, it's the YouTube piece that is going to be driving the positive revisions that we see going forward. Additionally, the new CFO who came from Morgan Stanley last year, she has really changed things dramatically there. We see margin expansion. This is a company that traditionally has spent away all upside. We see that coming back to shareholders.
All right, and then finally, another stock you like is Southwest Airlines. Now LUV, that's the ticker LUV.
Right.
It's down 14% in the past 3 months, but the rest of the airline industry only down 7%. Why is it lagging its competitors?
Well, that's the opportunity. Part of it was how it finished last year. Southwest had a very good end of last year. They had come out and talked about their revenue per average seat mile actually being slightly below the street for the last quarter. And that took the stock down. Now that was a very small adjustment. We actually see it going up. Since year to date, we have seen over 5 different rate hikes on the airline industry, and Southwest has been at the forefront of that. What I like about Southwest is it doesn't have a big international presence at all. It's basically domestic. They have a tremendous balance sheet. Companies are already locking in oil prices going out to 2017 at this point. They also have opportunity with their routes. There's been consolidation in the industry, and they're looking to gain gates during that time frame. Capacity for the industry, which had been increasing throughout 2015 and kind of put a lid on the group in the second half of the year, is actually now starting to roll over, and we see declining capacity growth the rest of the year. I love Southwest here.
All right, well, thanks a lot, Chris.
Yeah, great seeing you. Thank you.
And thank you for watching The Street.